It's not gold going up. I mean, when gold was hitting 5,500, open interest on COMEX was dropping. Basically, the speculators are not pushing it. People's Bank of China has on its balance sheet. I think we're looking at a figure which could be anything between 30 and 40,000 tons of state-owned gold. China has been basically selling dollars hand over fist. She's got record trade surpluses. She wants to get rid of dollars. How does she do that? Well, she's gone around the world and she's buying gold, silver, copper. She's stopping exports of sulfuric acid, fertilizers as well, etc. They have until July the 24th to close out their positions. Now, why July the 24th? The whole point about Hong Kong is when the dollar goes valueless, then Western capital markets are not going to work. And this is particularly important as far as COMEX, gold futures, silver futures, and also LBMA. They'll be dead. They'll be wiped out because these are paper markets. The complete collapse of the fiat currency system is not far away. Now we've got 4,000 and change. I mean, what's that? It's not gold going up. I mean, there is a bit of fluctuation, but it's all basically currencies collapsing. And that is the way to look at it. That's the way to understand it.
All right. So let me ask you this.
So we don't, I mean, Gary, the point I'm making is, it's not the supply of gold which is the problem. It's the quantity of fiat currency which is getting out of control. That is the problem.
How would you explain then the decline in gold price relative to fiat currency since the start of the war, 5,500 down to 4,000-ish? I guess you could look at that in reverse and say that the fiat currency, the U.S. dollar, has gotten stronger. How would you versus the collapse that was preceding it? How would you explain that?
I mean, what's fascinating is that, basically the dollar and co have rallied. I mean, that's what it is, mainly. I mean, okay, it's not entirely on the currency side, obviously. But just look at the level of speculation in gold. I mean, when gold was hitting $5,500, or $5,500, whatever, open interest on COMEX was dropping. I mean, it was basically the speculators are not pushing it. They're not pushing the relationship at all.
Gold didn't suddenly become less valuable. The measuring stick itself keeps changing beneath investors' feet. As Alasdair MacLeod points out here, falling speculative interest alongside rising prices challenges the popular belief that traders are driving this move. That leaves a harder question. If leverage isn't leading, who is quietly accumulating? For savers, confusing currency strength with purchasing power can become an expensive mistake. Next, Alasdair MacLeod exposes why temporary dollar rallies often disguise a much deeper monetary deterioration.
So it was really coming from the dollar side as much as anything. I mean, if you just look at the history too, I mean, when I had a look at Germany, its Reichsmark's collapse in the early 1920s, there were periods when the rate against the dollar, which was a gold substitute at $20.67 to the ounce, there were times when the Reichsmark actually rallied quite strongly against the dollar. I mean, as much as 25, 30%. But, anyone who got sort of suckered into buying the Reichsmark would regret it because it went on to, sort of 4 trillion Reichsmarks to the ounce, effectively. I mean, this is the nature of the beast. When you get a currency collapse, it's not going to happen in a straight, orderly fashion. And that's what we're seeing.
Okay. All right. So as we just mentioned, gold has fallen significantly from the pre-war highs of around 5,500. There's a lot of people out there, including some who are probably tuning in to our discussion, who believe that the $5,500 in gold was the high and relative to the dollar, and that it's going to languish for years like we've seen in the past. I'm sure you've heard this yourself. If that's the case, why would central banks, the global monetary authorities, why would they be planning to buy gold in record numbers?
Short-term recoveries have repeatedly convinced investors the worst was over, right before the real damage began. According to Alasdair MacLeod, history shows collapsing currencies often experience powerful counter-trend rallies that create false confidence. Today's pullback may look familiar, but central banks buying record amounts of gold suggest policymakers are positioning for something very different. Wealth preservation depends on recognizing actions instead of comforting narratives. Next, Alasdair MacLeod reveals the contradiction between official confidence and unprecedented central bank demand.
Why would China specifically want to purchase something in such robust numbers whose worth is declining or flatlining relative to fiat currency? What's the benefit and value to them and in owning and continuing to add to their stockpiles of gold, both China and all these central banks, if the folks who believe that the gold price relative to fiat is going to languish for years, if they're correct, why would these global powers of money, why would they exchange the fiat for gold?
Well, the answer is that they're not correct. The central banks know this. Whatever they say in public, they actually do understand, and particularly the Asians, if you like, China and so on and so forth. They understand what real money is. I don't know if people in the Treasury understand, in the US Treasury understand it. If they do, they're keeping very, very quiet, and they've got absolutely no interest in rocking the boat. The fact of the matter is that the dollar is going down. That's what we're looking at. We're not looking at gold going up. If you look at the US Treasury's finances, part of this problem that's been generated by this attack on Iran is that foreign investors are no longer interested in adding to their US treasuries or indeed their dollar positions. So, they're turning sellers. Now, this does mean that bond yields are going to rise.
Foreign demand is fading precisely when Washington needs it most, and that shift rarely makes the headlines. What Alasdair MacLeod is highlighting is that central banks are exchanging paper promises for tangible reserves while publicly defending the existing system. If overseas buyers continue stepping away from treasuries, financing deficits becomes increasingly expensive for everyone. Investors should watch institutional flows, not official speeches. Next, Alasdair MacLeod exposes why rising bond yields may be only the beginning of the adjustment.
And once you see the 10-year bond yield sort of nudging 5%, you have to ask yourself, where is this going? And I can tell you that the last time we had a similar oil crisis, which was 1973, you'd be looking at bond yields going well above 5, well above 10%. And various G7 countries are going to be in huge difficulties. I mean, we're already seeing a very nasty collapse in the value of the Japanese yen. Now, Japan happens to be the biggest exporter of capital to the other G7 countries that there is. The consequence for the purchasing power of the dollar is that it is going down. China understands this. China has been basically selling dollars hand over fist. She's got record trade surpluses. She wants to get rid of dollars. How does she do that? Well, she's gone round the world and she's buying gold, silver, copper. She's stopping exports of sulfuric acid and, things like that, fertilizers as well, etc. All this amounts to is she obviously reckons that the dollar is toast. She's getting out of the dollar. At the same time, she's accelerating the requirements for the yuan to go onto a gold standard in order to protect it from a collapse in the dollar. This is quite clear from her actions.
A 5% bond yield may sound ordinary, but history suggests it can mark the start of much larger financial stress. Alasdair MacLeod's argument suggests China's commodity buying and dollar selling reflect preparation rather than panic. That combination affects currencies, borrowing costs, and ultimately household purchasing power across developed economies. Ignoring these capital shifts could leave traditional portfolios dangerously exposed. Next, Alasdair MacLeod reveals why China's resource accumulation carries a message far bigger than commodity demand.
So the dollar is toast. Now this changes things as far as BRICS is concerned. It's not something that you can sort of gradually evolve anymore. You can forget about the talk of which I never took seriously anyway, of a new BRICS currency sort of thing. That was never going to happen, let's face it. But as far as BRICS is concerned, I don't think actually it matters anymore. The whole point of it is the collapse is coming from America, not from the rest of the world. America is not in a position to impose its will on other nations around the world. And increasingly, these other nations are beginning to understand that, to use a Chinese term, America is no more than a paper tiger. So I think that's the fundamental change that we've seen literally in the last 12 months or so, Gary.
All right, Alasdair, are you expecting China to continue to want to net settle in gold and be able to enforce that if they need to militarily, but with their economic strength, et cetera, with other countries around the world, including the U.S.?
She doesn't need to. She doesn't need other countries to settle in gold. She's got quite enough gold. What she needs, if you like, is to provide her allies, her trade allies, with a stable currency to replace the dollar. And if you just look at what she's been doing, it's absolutely clear that this is the direction in which she's going.
The biggest monetary shift may not require a new global currency at all. This is where Alasdair MacLeod's thesis shifts by arguing that trust, not branding, determines reserve currency status. If trading partners receive a more stable settlement option, demand for dollars can erode without dramatic announcements. Investors waiting for one historic event may miss a gradual transfer of financial influence. Next, Alasdair MacLeod unravels how China's infrastructure quietly supports that transition.
By setting up vaulting facilities in Saudi Arabia, by expanding vaulting facilities in Hong Kong, she's now in the position where she can literally say overnight, right, this is the exchange rate between yuan and gold, fixed. I expect what she would do before doing that is reveal how much gold she's actually got as a nation. And it's not the 2,300 odd tons which the People's Bank of China has on its balance sheet. I mean, I think we're looking at a figure which could be anything between 30 and 40,000 tons of state-owned gold, which would really throw the cat amongst the pigeons. Now, it's interesting that she has recently, I mean, she is very worried about the dollar. I mean, don't get me wrong on this one. She has, I think in February, she turned around to her own banks, the commercial banks in China, and said, if you've got US Treasuries, lighten up. She didn't turn around and say, sell, sell, sell. I mean, she can't do that, can she? Well, she could, but it would be very undiplomatic. What she did basically was she told them to sell. Get out. And then we had, more recently, we've had the situation where she's turned around and obviously instructed the banks to remove as much as possible speculation in gold and silver in the domestic Chinese population.
Infrastructure usually appears long before a monetary transition becomes official. Alasdair MacLeod notes that expanding vault networks and quietly reducing treasury exposure point toward deliberate long-term positioning instead of reactive policy. Whether every estimate proves accurate or not, the strategic direction deserves attention from investors. Institutions often prepare years before the public recognizes a structural shift. Next, Alasdair MacLeod exposes why limiting domestic speculation may actually strengthen China's broader monetary strategy.
They have until July the 24th to close out their positions. Now, why July the 24th? I don't know. My guess is that that's probably got something to do with the maturity of the current futures contract on the Shanghai Futures Exchange. I don't know, but anyway, that seemed to me to make some sense. Instead, what she's doing is she's now beefing up Hong Kong very rapidly to handle international transactions in gold for Chinese yuan. She has also put in place mechanisms whereby, if you like, the refining of gold and re-refining of gold and all the rest of it will be done in Shenzhen specifically for the Hong Kong market. And then literally just a few days ago, she turned around and changed the regulations, if you like, or the mechanism, whereby if you wanted to export gold from China, you no longer have to, I mean, this is in consultation, admittedly, but it's going this way. You no longer have to consult or get the agreement of the People's Bank. All you need do is make a customs return. Why? I mean, it all adds up to one thing, and that is gold is coming back into being the center of the future monetary system. Now, China has a problem with this because if she just did that today, she would collapse the dollar, and she would be blamed for collapsing the dollar.
Regulatory changes often matter more than headline announcements because they reveal where policymakers expect capital to flow. According to Alasdair MacLeod, China's adjustments around gold trading and exports resemble preparation for larger international settlement capabilities. These incremental decisions rarely receive mainstream attention until the framework is already complete. Patient investors benefit from following infrastructure instead of headlines. Next, Alasdair MacLeod reveals why Beijing may deliberately avoid triggering a dollar crisis.
She doesn't want that. She basically wants to be seen to react to protect herself, not go on an aggressive stance. So we're likely to see things deteriorate as far as the dollar is concerned. And I tell you what, she knows what's going on in the Gulf a lot more than President Trump does. She wants to, if you like, see things deteriorate further before she actually implements some sort of gold standard. My guess is it would probably be something like a Bretton Woods Mark II, whereby it would initially anyway be available to international trade settlement through the SIPS system, China's payment system, which virtually everybody's got access to now. I mean, it's amazing how many people have access. Now, I know it only handles a small part of total global international trade, but the facility is there. She's put everything in place to replace the dollar. And guess what? The whole point about Hong Kong is when the dollar goes valueless, then Western capital markets are not going to work. And this is particularly important as far as COMEX, gold futures, silver futures, and also LBMA. They'll be dead. They'll be wiped out because these are paper markets. So that's basically what she is doing. And I think that this is sending a signal to all of us, Gary, that the complete collapse of the fiat currency system is not far away.
Major monetary transitions rarely begin with dramatic speeches. They begin with systems built quietly in plain sight. What Alasdair MacLeod is highlighting is that payment networks and settlement infrastructure matter far more than public rhetoric. If alternative channels become widely trusted, paper pricing mechanisms could gradually lose influence over physical markets. That's a risk conventional portfolio models often ignore. Next, Alasdair MacLeod exposes the institutional buying trend reinforcing this broader monetary shift.
All right, so Alasdair, on top of everything you just laid out there, the World Gold Council recently did a survey of central banks to see what their gold purchasing is going to be for the remainder of 26 and into 27. And it was a record-breaking amount of central banks are saying they're going to buy. There was only one that said they're not going to buy, that they might lighten the load a little bit. Everybody else essentially said we're adding, and we're adding big time. At the same time, gold supply has been very stagnant for more than 15 years. Explorers are cutting back exploration budgets. Few major new discoveries have been found. Producers have been focusing on improving their balance sheets over building out reserves. So we have this increasing demand and a very stable supply, and an environment that you've described where the U.S. is likely going to have to debase the purchasing power of the dollar more aggressively in the coming years due to an increasing budget deficit and fewer large buyers for their treasuries. Can gold supply respond quickly enough to this type of rising demand and stable supply environment?
It doesn't have to. The way to look at it is it's not the gold price rising. I know that's in everybody's balance sheet, that's what it looks like, but it's not. It's actually paper currencies collapsing. So, the supply of gold over the centuries and the millennia basically has more or less kept pace with the increase in the world's population.
Record central bank demand colliding with stagnant mine supply creates pressure that simple price charts rarely capture. Alasdair MacLeod's argument suggests investors should focus less on nominal gold prices and more on declining currency purchasing power. That distinction changes how long-term wealth preservation is measured during monetary instability. Looking only at dollar returns risks missing the bigger trend. Next, Alasdair MacLeod reveals why gold's historical stability still matters in modern markets.
Now, this is very, very important. This is given gold, if you like, a stability in terms of its purchasing power, because everybody accepts gold as final settlement without counterparty risk. It's all, as far as we Europeans and you Americans and Canadians and all the rest of it are concerned, it's in all our common laws because it was in Roman law from which our common laws all originated. So this is accepted. It's accepted that is, if you like, the stable, purchasing power, if you like, of which currencies as gold substitutes should be attached to, but they're not attached to it, and which is why currencies are losing purchasing power. And this is reflected in a move from, back in the early 1930s, you had 20.67 dollars to the ounce of gold.
Most investors chase returns while overlooking the asset historically designed to preserve purchasing power. This is where Alasdair MacLeod's thesis shifts from price speculation toward gold's role as final settlement without counterparty risk. If currencies continually lose value against scarce assets, the real question becomes what your savings will actually buy in 10 years.